In 2023, we witnessed a series of dramatic changes in global capital markets. The United States experienced the banking crisis and the continued increasing interest rates accumulatively by 100 basis points of the whole year. However, the Nasdaq index surged by an impressive 43.32%, setting a new record in the history. What new trends will the global capital markets present in 2024? Will the U.S. stock market maintain its upward momentum? Three economists from renowned institutions provide their interpretations for us.
If you even look at some of the more granular, like month-by-month listings data, you're starting to see companies coming into the market. Some really big listings came through late last year. And if you talk to the private equity businesses, there's a lot of investments that they've been holding on to for longer than they normally want to. So there's a good pipeline of IPOs ready to come to market, people that need some equity market cash. We've got markets close to all-time highs, so valuations aren't holding it back, and volatility is low. So I think the environment is pretty constructive for the IPO market to come back and be a bit stronger than, at least a bit stronger, hopefully a lot stronger than last year. I think uncertainty, generally. I mean, if you look at the bond market with interest rates getting to their peaks, but no one really sure whether the Fed was completely finished or about to cut, and all of the indicators about consumer spending maybe running out of money, there was a lot of uncertainty that we might have a recession. And so that, I think, made a lot of companies a bit nervous about coming into the market and IPOing if the very next year they'd have a recession to deal with. With the soft landing more and more likely, I think that's, again, even more constructive to get companies into public markets, which is great for investors because it's more growth companies for us to buy and hold and participate in their growth as well.
Well, mainly because we're going to start to reverse the tightening cycle. So in level terms, yields they're not historically high, but they're certainly back to where they were, 15, 20 years ago. The central banks generally perceive themselves to be well above neutral levels. So as they start to go back towards neutral, the bond yields will decline, and so bond prices will rally. And so as an entry point, the market is already responding to that. But I think that is sort of the most straightforward thing this year is that when inflation comes down, bonds do well. And that's the simplest thing to do this year. If you do anything, that's what you want to do. And equity, I think, is difficult in part because risk premia are so compressed, right? So if you go back in history and you look at how do equity markets perform in a year when credit spreads are this low, when volatility measures are this low, they generally don't do so well, right? So equity markets do well when your starting point is very bad and then there's something to recover from. But the starting point in this case is that things are not so bad, and then it's difficult to sort of do well. So for that reason, we prefer this year bonds over equity, but that's really sort of a recommendation for 24. It's not a medium-term recommendation. It's just a tactical recommendation. So the S&P 500 is really split between the Magnificent Seven, sort of the big tech stocks, right, and everything else. And the everything else is not doing so well. Okay, so the earnings for the non-tech sector is, we think it's going to be flat in the first quarter. It's severely underperformed tech stocks in the fourth quarter. So the S&P is this average of these two different parts of the economy. So now looking at what's going to happen this year, we still think the S&P will go up despite the recession, but not by very much. So what we think is going to happen, if you listen to our equity strategists, is that the market will, for now, continue to sort of go up. If the recession happens, there would be a drawdown, right? This always happens in recessions. And then there would be a quick recovery if the Fed starts cutting. And then by the end of the year, you're back above where you started, right? If there were no recession, we'd be a lot higher than what we're forecasting. So right now, because we're worried about that recession, we prefer to be in defensive sectors, so things that have, or high quality sectors, which means firms that have a resilience to weaker demand, right? So that are not so sensitive to weaker demand. So in general, we like defensives versus cyclicals. So, healthcare stocks, utilities, things like that. That's sort of a general recommendation, not just for the US, but also for Europe. If you look at it globally, we're actually neutral on tech globally, but we like North Asia tech, we like China internet, so as we spoke about. I think in local fixed income, which is our favorite sector in emerging markets, so the way I'd frame that is, so emerging markets tightened more than developed markets, and they did it earlier and were at higher levels historically than developed markets. Inflation is falling faster in emerging markets, which is interesting, right? So Everyone had an inflation shock, but it's actually correcting faster in emerging markets than developed markets. So what that means is that the central bank can reverse those tightening, the level of interest rates actually faster than the developed markets. And so that is a sector that's really going to outperform. So local fixed income, bond markets, we think is sort of the safest place to be in emerging markets. Equity, much more tricky, right? So emerging market equity, I identified a few sectors, but if you take the entire asset class, now when do emerging market equities outperform? It's when commodity prices go up. They're not going up. It's when credit spreads can compress. They're already very low, right? So it's when growth differentials improve. Yes, that's going to happen. But it's not that straightforward. And if the S&P does have a drawdown, so a correction because of a recession, emerging markets are going to go down more than the S&P. So that's, I think, the problem for equity. If you look at currencies, they actually look pretty expensive. So again, we'd prefer to stay clear of those for now. You know, it's not having much of an impact, right? There's a war in Russia-Ukraine, obviously. There's a conflict in the Middle East. That's not had a big impact even on oil markets, which is interesting, right? So it's always a risk, right? I think oil prices going up is definitely one of the risks to our forecast. I think as a political risk, what's coming into focus is much more, you know, some of the elections that we have this year. So there's a whole range of countries with important elections. The most important one being the U.S., right? The U.S. election is later this year. It's becoming a major debating point, right? Whether or not we get a second Trump presidency, I think would have a big impact potentially on markets. It's not clear, right? So on one level, there's a lot of conventional wisdom around these U.S. elections where, you know, people say that if Trump wins, then it's good for equity and bad for bond markets, right? It's good for equity because people think they're going to get a repeat of the last time, where you get deregulation, lower taxes, things like that. But it's bad for bond markets because the deficits don't come down. But that's sort of a little bit simplistic, because I think, you know, if you go back to 2016, when Trump was elected the first time, we didn't actually know at that time how aggressive he was going to be on tariffs, right? So I think the way his potential victory would be interpreted this time could well be different from last time when the markets rallied. So I think we have to wait and see. People are definitely nervous. I think, you know, there's a lot of conversation about what that would really mean. But that is probably the biggest political event, at least, that the market is going to try to trade this year.
Yes, obviously something people are going to be watching very closely. There's lots of different aspects of this. Obviously, under the question that we receive a lot from investors is if there was a victory from President Trump, what would that mean for U.S. policy, and how would that affect the rest of the world? Obviously, you know, his first term there were some significant tariffs were placed on China, which had not been removed. You know, there were lots of threats of tariffs on other countries, you know, including Mexico, for instance. So that is one concern that we see more protectionist policies come in. I think one issue that we will be watching quite closely is one development that you saw under President Trump's first term before the pandemic was a very sharp slowdown in U.S. net immigration. Now, the U.S. labor market at the moment is tight, but things kind of eased a bit on the supply side of the U.S. labor market in 2023 because we saw a big recovery in net immigration. So we didn't really have an improvement in labor force participation. The share of over 16, the share of people over 16 that were working in the economy didn't really move up very much. That sort of ratcheted down after the pandemic, has not really recovered, but there was an improvement in immigration, and that was a factor that was helping employment growth and helping GDP and preventing wage growth for rising much more rapidly. If we were to see a sharp slowdown in immigration, that could mean that the US labor market conditions tighten even further, which would be a problem for the Fed. Unfortunately, there's lots of uncertainties this year with conflicts going on in various parts of the world. So I think there are lots of key risks of which that is one. Obviously, US economic policy is hugely important to the rest of the world. So clearly, it will be very much in focus. But China's growth outlook, the prospects for the European economy, the weakness in Germany's economy, global implications of the rise in interest rates of the Bank of Japan. So there are lots of issues, lots of uncertainties out there, which this adds another level of complexity.